Welcome to Morphic Labs, and today we are going to be discussing why, if you don't understand expected value, you don't understand trading. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. I would greatly appreciate your support. And if you're interested in increasing your market intelligence, which if you're into trading or markets in any capacity, you should be interested in increasing your market intelligence. If that sounds like you, I have a free market microstructure and trade systems resource that walk you through the foundations of market structure, the mechanics of trading market data, and it relates everything from market structure and trading venues, order types and execution to liquidity and market impact. And if you're interested in looking at markets from different angles, I also have a free advanced market aggregation resource that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow market structure aggregation, event-driven and hybrid methods, plus implementation and selection criteria, so you can pick the most optimal aggregator for your specific use case. If you found that interesting, the links are in the description. Just sign up to be a free member, and you're able to use resource all to yourself for free. Now let's get into it. Now, this is the expected value per trade formula. And if you don't understand this, you do not understand trading at all. You should just go to a casino. You'd probably have better odds there. Now, the expected value per trade measures the expectancy of a strategy given the win probability, the loss probability, the mean winning trade, and the mean losing trade. Right? Simple enough. Now, let's assume you have a strategy that has a say 90% probability of winning. Your average losing trade, your average winning trade, essentially makes about 10%, right? So on average, for every dollar that you put up, you make about 10 cents, and your average losing trade is about 0.7, right? Meaning that on average, for your losses, you essentially lose about uh, 70 cents on the dollar, right? And let's say you have a fairly volatile trading behavior, and you take about 20 trials or 20 trades, right? Now, what is the expected value of this specific strategy? It's a positive EV strategy, meaning that if you play this game over a long run, you should expect to make about 2 cents on average for every dollar that you put up. Pretty good strategy, right? Now, if you pay attention to these outliers, as you can see, there are periods where essentially you lose over 200% on a dollar, right? So you put up a dollar and you lose more than that, right? You essentially lose $2 when you put up one. And as you can see over here, it's the same thing. You put up a dollar and you lost about $1.83, right? Over here on your 13th trade, you put up a dollar and you made about $2.32, right? But on average, you essentially tend towards this green line in the middle, right? Now, let's say your strategy has a 50% probability of winning, and essentially your average winning trade makes about say 30 percent, and your average losing trade loses about 90%, right? Volatility of 1.5 over 20 trials. Let's look at the expected value. As you can see, this is a negative EV game, right? Meaning that regardless of how quick your entries are, how good your timing is, what news channel you watched, you will lose all your money if you keep playing the specific strategy, right? And as you can see, the losses can do get crazy, right? We have a over 200% loss over here on a dollar, over 100% loss over here on a dollar, and this is just for 20 games, right? You play this game for longer. Let's say you play this game for 100 trials. So you play this game for 400 trials. As you can see, the losses can get very, very crazy, like a 500% loss on a dollar, right? And obviously, in real life, most retailers are more volatile than just 1.5, right? Let's see what happens when we increase the volatility. Say a volatility of 5.5, right? As you can see, there are periods where you actually make much more than 100%, right? And this is on your fourth trade. Look here, over here, you made much more than the 100%, right? But these are just outliers. On average, you lose all your money, right? As you can see over here on your 70th trade, you lost much more than 100% that you put up, which is should be concerning to anyone who wants to participate in markets, right? And that's about it for today. Essentially, your average winning trade and average losing trade are not as important as the expected value itself, right? Because you could have a positive average winning trade, but you can still have a negative EV, right? And essentially, if you do not understand expected value, you do not understand markets at all, right? Because you might go into the market and get lucky, and then and just right make a lot of money off your fourth trade, like as you can see in this specific pair trade path, right? Let's run this again with this same level of volatility, right? As you can see, look over here on your 27th trade, you made over 800% on a dollar, right? You go in and you're thinking that I'm a winner, I'm amazing, this strategy works, but in reality, you just won because of luck. Over time, you will lose all your money because this is a negative EV strategy, right? But that's about it for today. If you enjoyed this, hit the subscribe button. I would really appreciate your support. And if you're interested in increasing your market intelligence, which if you're into trading or markets in any capacity, you should be interested in increasing your market intelligence. Um, if that sounds like you, have a free market microstructure and trading systems resources that walk you through the foundations of market structure and mechanics of trading, market data, and analytics, everything for market structure and trading venues to liquidity and market impact. Plus, if you're interested in looking at markets from different angles, I also have a free advanced market aggregation resource that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow market structure aggregation, event-driven hybrid methods, plus implementation and selection criteria so you can pick the most optimal aggregator for your specific use case. If you found that interesting, the links are in the description. Just sign up to be a free member and you have both of these resources all to yourself for free. And that's about it for today. If you enjoyed this, hit the subscribe button. I would really appreciate your support. And I'm out. Bye.